Hey guys, welcome back to another video. So we are due the much anticipated CPI reading for August on Tuesday. So the reason this is going to be particularly important is we saw that we had a weak August non-farm payrolls, and we saw that this could all but mean the nail is in the coffin to begin tapering very shortly from the FOMC. But a slightly hotter inflation reading could change that course of action. So the Fed will be watching this CPI reading very closely, and a hot CPI could be the difference between a September versus a November taper. And this could have impact for the bond markets and also obviously broader equities. Now, the expectation for consensus on this month's reading, for August reading, which is going to come out, is we're expecting a slight deceleration from what we saw. So in July, in the reading published, we saw 0.5% growth in inflation month on month and a 5.4% year on year. Now, consensus estimates from economists are suggesting a slight deceleration to 0.4% from 0.5%, and that's month on month, and 5.3% year on year versus the 5.4%. So if I show you that on a graph, you will see that this is where we're at. So you can see these were the readings that we've kind of been seeing. We saw 2.6, April 4.2, March 5, May 5.4, June 5.4, July came in at 5.4 again. They're expecting August to just show a slight 5.3, and that would suggest that we've hit a peak of 5.4. Now, any shock to the upside, whether it's a 5.4 or even worse, 5.5, 5.6, that is where we can start to see the Fed start to have discussions around bringing tapering closer to the September mark, which will be interesting. Could we see a September or October taper? It's going to be highly dependent on this inflation reading. I mean, we had a weaker non-farm payrolls. We covered that on this channel. It was 235k new jobs versus the 750k, so that was a horrible miss. And the inflation reading, if that continues to come in hot, that could bring up this conversation of tapering. Now, we know that we've seen a slight. Let's take a look at the report from July. We saw some of the headline categories which were driving this heightened CPI reading. We saw them start to trend down. So if we take a look here, you can see new used vehicles. Let's take a look. So you can see here for used cars and vehicles, you had 10% growth, 7.3. 10.5, and then it came down to 0.2 in July. So it's almost saying, look, there was this panic as supply chains were shortening. That peaked it to 7.3 and 10.5 levels, and then now it really decelerated sharply to 0.2. So what are those readings going to come in at August? That's the key here. And we saw that for a few different things. So that was apparel, for hotels, for airlines and tickets, and all these kind of things. We saw that they accelerated sharply, and then we saw it decelerated sharply as well. Now, the broader concern is, as people have become more and more vaccinated, will we see more persistent inflation? So, Jerome Powell and the Fed have always stood behind the fact that this is transitory inflation. It's going to be here, similar to what we just showed with the used cars and trucks. It's going to spike up and it's going to disappear. And if we start to tighten our monetary policy any sooner, then that could lead to damaging the economy further and actually hindering what we're trying to achieve. Remember, we covered that extensively on this channel. So almost he's saying it's going to be transitory. Now, the other evidence is suggesting, whilst those categories might be transitory, such as used cars and trucks, airlines, motor insurance, hotels, there's another broadening category of areas where we're seeing more persistent inflation. As more and more people getting vaccinated, food, services, people are getting out and about more, restaurants, could we see these areas become more and more persistent in the core reading? And ironically, this is exactly what Jerome Powell alluded to at the Jackson Hole Symposium, where he discussed and he mentioned and he used historical examples in the 70s of where you had transitory employment, but core CPI, even when the transitory issue subsided, the core CPI continued to go up for a long period of time afterwards. And he actually used that as his example, which is very interesting. Now, we know that if we do get some sort of an announcement for tapering, it's going to cause an issue for the bond market, as there's going to be much less treasuries being purchased. And also any sign of a closer rate hike, because we know that once the bond purchasing starts and we start going down the path of being more hawkish, and tightening monetary policy, then it's closer and closer to seeing interest rate hikes. And that could lead to some mutiny or panic in the stock market. Okay, so this is going to be interesting reading here. If we see a high, hot inflation reading, I wouldn't be surprised if we see a bit of an issue with stocks, and that could then lead to force Jerome Powell's hand. The FOMC are meeting 21st, 22nd of this month, so it's just a week after this CPI reading, so it's going to be hot on the agenda, and it's going to be interesting to see where we head into. Now, that brings us to a conversation around stagflation. So economists have started to talk about stagflation, and they're saying we can smell the signs of this stagflation. Now, they're saying that a combination of higher inflation and lower spending is going to lead to stagflation. But the reality is you'll have stagflation where your employment is really high, but your spending, your economic growth is really low and your unemployment is rising. We've not actually seen that. We've seen unemployment fall, albeit it decelerated in the August report, but perhaps that was just a hiccup, because the trend over time is we've seen a sharp improvement in employment from the worst of the pandemic. We're starting to really trend back to pre-pandemic levels, but we just did see a bad reading in August. But even then, it was still more jobs. Unemployment wasn't increasing, it just wasn't meeting consensus, and that's the important differential there. Now, is that going to be an issue? I mean, normally, so the issue with stagflation, just coming back to that point, is if you have a combination of high inflation, but the underlying economy is weak, so you've got high unemployment, you've got slowing GDP growth, and the economy is not growing as fast. Any action that the Fed wants to take through fiscal or monetary policy, or tends to be monetary policy, can exacerbate the unemployment issue. And that's the trouble here. But I don't feel this is the case. I'm quite clear on this. A lot of people are starting to speak about stagflation. It does smell of stagflation. I can see why people could assume it's stagflation. But the fundamental thing is we're not seeing unemployment rise. We've seen more jobs than ever before. There's over 11 million jobs available in the States. And we are seeing more and more jobs being added over time, and we're seeing earnings go up. There's more spending in people's pockets, and I think that's what we're going to see going forward. Now, coming onto it, we also know that some of these supply chain issues are going to persist. I made a video where we covered what the CEO of Ford and VW Group have said. General Electric have also said that these supply chain shortages are going to go well into 2022, and some are even saying 2023. So anybody who's kind of the impression that this is just going to be some really quick couple of months of inflation and we're all going to be good, it's kind of not the case. That's not what these businesses are saying. They're saying they're seeing a longer term supply chain shortage, and naturally that's going to lead to cost push inflation to the end consumers. And I think that's what we're going to see. Now, coming back to what this means for the stock market and equities, September and October tends to be a really volatile period for equities anyway. Now, given the CPI reading, given the FOMC meeting 21st, 22nd, and given the fact that we've been on a tear. I mean, let's put this into perspective, guys. We were up 30% in 2019, we were up 18% in 2020, and 21% year to date this year on the S&P. Okay, so valuations are extended. Things will get tougher from here on in. I don't think there's going to be as many quick wins. So don't be surprised to see if we see a bit of correction. We've gone a long time without a 5% correction in the broader S&P, which we tend to see and is quite healthy. And all these things are kind of aligning. You've got September, October volatile period. You've got the FOMC meeting. If we see a peak in inflation, this could all lead to qualms and general kind of risk-off appetite. So there you go, guys. That's the expectations around the CPI reading on Tuesday. We'll make sure we cover the results of those here. Again, to repeat, we saw 0.5% month-on-month growth in July, expecting that to decelerate down to 0.4% month-on-month. We saw 5.4% year-on-year, expecting that to decelerate slightly, 5.3%. Anything above 5.3%, and if it's above 5.4%, which was last month's reading, if we see 5.6, 5.7, 6%, this could really put it at the front of the agenda for the Fed to say, I think we need to start thinking about tapering. And that's going to, what concerns could that put on the market? Could we see, a bit of a taper tantrum? These are all going to be interesting. And because just And just to kind of labor this point a little bit more, so we spoke about how good a job Jerome Powell was doing in telegraphing the taper. It's been on the top of his mind for quite a while that I don't want to see a taper tantrum. I want to make it clear to everybody when we're going to taper, I'll make it clear. But the reality is Jerome Powell has to react to the data he has on the table. So at Jackson Hole, he says, I need to react to the data. So fine. He gets the non-farm payrolls, which surprised to the downside, horrible reading, and got everybody, including myself, thinking, oh, that's the end of taper now. We might not see taper into January. But then if inflation comes high on Tuesday and comes in at 6%, 6.5%, or shows a trend which reminds us that it's not transitory, then perhaps tapering needs to come back on the table. But this time, if tapering comes back on the table, who's to say equity investors won't be spooked, and that could lead to a taper tantrum, right? Because they're getting mixed messages, and that's what investors don't want. They want a clear course of action so they can move their assets accordingly. And if anything happens out of the blue where they suddenly think, oh, we've gone from a January taper to now a September taper, that's 4 or 5 months they've lost, and then that could lead to the taper tantrum. So definitely something I'm keeping an eye on. It's an interesting kind of dichotomy because it's not really Jerome Powell's fault. He's trying to telegraph it as best he can, but he needs to react to the data. And if the data is coming out suggesting that the economy is overheating, he's got to pull the levers he needs to pull, and that's what he gets paid for. So there you go, guys, an update on the general economy and CPI. If you like my perspectives and how I break these things down, please don't forget to subscribe for more insights like this, and I'll look forward to seeing you in the next one.